Hi there. A lot of talk lately about silver possibly getting ready for a major breakout. And depending on who you listen to, it either sounds like the move is already locked in or it sounds like another emotional rally that is going to trap late buyers. So in this video, we're going to separate the real setup from the noise. And you are going to walk away understanding why silver is moving, what could push it higher, and what still has to be watched very carefully. Today is Tuesday, May 12th, New York time. Before we go any further, comment the day and date you are watching from because I want to see where everyone is tracking this move from. And real quick, if you value this kind of original breakdown and you want to support the channel, subscribe and comment John AG Best. That helps push real research above the copycat noise, and I appreciate it. Now the story starts with silver waking up before gold. That matters, because in a normal precious metals rally, a lot of people expect gold to lead and silver to follow. Gold is usually the serious one, the institutional one, the one central banks talk about. Silver is usually the wild one. It waits, it frustrates, it shakes people out, and then suddenly it moves so fast that everyone acts surprised. That is basically what we are seeing now. Silver has bounced sharply from its recent lows, and the important part is not just the size of the move. The important part is where it happened. After a deep correction, silver started climbing back through levels traders were watching closely, while gold was still trying to repair its own chart. The raw outline we are working from says the original discussion framed silver as leading gold, tied the move to energy risk, inflation, debt pressure, and a possible stagflation environment, and also warned that ordinary people may feel the pressure through fuel, food, and shrinking monthly budgets. So the first question is simple. Is this a real breakout or just a bounce? And the honest answer is it could be both in stages. Let me explain what I mean. When silver falls hard, bearish traders get comfortable. They start assuming every rally will fail. They short the move, they lean into the downside. And then, when silver suddenly pushes higher, those same traders have to cover. That forced buying can make a rally look explosive even before the long-term buyers fully show up. So yes, part of the move can be technical. Oversold market, short covering, momentum chasing, a little fear of missing out. But that does not mean the move is fake. It means we need to understand what is underneath it. Because underneath this silver move is a much bigger macro story. Energy is unstable. Inflation is not dead. Government debt is heavy. The Fed is trying to look calm. And the industrial side of silver demand is still very real. Based on recently published numbers, the silver market has been dealing with tight supply and strong industrial use, with demand from areas like solar, electronics, electrical systems, and manufacturing remaining a key part of the story. The latest silver market survey also pointed to another expected market deficit, which is important because silver is consumed in industry in a way gold simply is not. That is why silver can suddenly lead. That is also why I would not dismiss the move just because it started as a technical rebound. Strong markets often begin with a mechanical move, then the bigger story catches up. First the shorts cover, then the chart improves, then the cautious buyers return. Then the people who waited for certainty realize certainty was the most expensive entry point. That is how momentum sneaks up on people. It is not just a monetary metal. It is also an input. And when investors and industry both want the same metal at the same time, the market can get very uncomfortable very quickly. Now, before anyone gets carried away, uncomfortable does not mean straight up forever. Silver can still drop. It can still shake people out. It can still punish anyone who buys too emotionally. But the setup is different when the macro backdrop starts lining up behind the metal. And right now, one of the biggest pieces of that backdrop is oil. The Strait of Hormuz is not just a map detail. It is one of the most important energy choke points on the planet. Recent public energy data shows that roughly 1/5 of global petroleum liquids consumption has moved through that route, and another major energy agency describes it as carrying around 1/4 of seaborne oil trade, with limited alternatives if flows are disrupted. So when that region becomes unstable, oil does not wait politely for everyone to finish debating. Oil reacts. And when oil reacts, everything else starts listening. Fuel costs listen. Freight costs listen. Fertilizer costs listen. Food costs listen. Airline costs listen. Small businesses listen. Families listen even if they do not know they are listening yet. That is the part people miss. An oil shock is not just something traders argue about. It is a cost that travels through the economy. At first it is gasoline. Then it is shipping. Then it is food. Then it is margins. Then it is wages. Then it is the monthly budget. And by the time people finally say, "Why is everything getting expensive again?" the chain reaction has already been moving for weeks or months. That is why I take the energy part seriously. And this is where the recent supply-side updates become important. Public oil market tracking has described a major disruption to global supply, with output and refinery runs under pressure because tankers, insurance, routing, and refinery feedstock are all being affected at once. In plain English, that means the issue is not only the price of crude oil, It is the ability to move it, refine it, and turn it into the products people actually use. That is why the inflation risk can linger even after headlines calm down. People often think, okay, if the shooting stops, the price should fall tomorrow. Sometimes it does, but supply chains do not reset like a phone. Tankers have to be repositioned, inventories have to be rebuilt. Refineries need the right type of feedstock. Buyers need confidence that the route will stay open. And if companies were drawing down reserves during the disruption, they may need to refill those reserves later, which creates another round of demand. So the market can get relief and still remain tight. That sounds contradictory, but it is not. It is the same reason grocery prices can stay high even after a farm input price stops rising. The shock enters the system quickly, but it leaves slowly. Fertilizer is a good example. Energy is a major input across fertilizer production and transport, and recent commodity updates have warned that fertilizer prices are part of the broader pressure building in global commodity markets. That matters because fertilizer affects crop costs affect food prices, and food prices affect every household, not just investors. So when silver people talk about energy, they are not being random. They are talking about the pipeline from oil to inflation to central banks to real rates to hard assets. That is the chain. And if one link tightens, the whole chain starts pulling. But here's the counterpoint. A serious energy risk does not automatically mean silver explodes tomorrow. Sometimes a shock makes investors buy metals. Sometimes it makes them sell everything to raise cash. In a real liquidity squeeze, people do not sell what they hate. They sell what they can. So if markets get scared enough, silver can get hit first, even if the long-term thesis improves. That is the tricky part. Bad news can be bullish for silver over time, but bearish for silver in the moment. So we do not want slogans. We want structure. Is silver holding higher support? Are buyers stepping in after pullbacks? Is gold confirming the move? Is the dollar weakening or strengthening? Are real yields easing? Are industrial demand expectations still firm? Those questions matter more than one loud headline. Now, inflation is the next piece. The latest official consumer price data showed inflation running above the Fed's long-term goal, with energy rising much faster than the overall basket and food still adding pressure. That does not mean every single price moves the same way, but it does mean the average household is still dealing with a cost environment that does not feel calm. And that puts the Fed in a difficult position. If inflation cools, they can talk about easing. If inflation heats back up because energy and food rise, cutting rates becomes harder. But if the economy weakens while prices stay high, then they are stuck in one of the ugliest policy environments possible. You get slower growth on one side and sticky inflation on the other. That is the kind of setup people casually call stagflation, but for households, the word is not the important part. The important part is this: your paycheck does not stretch. Your bills do, and that is where metals regain attention. The Fed itself recently said inflation remained elevated in part because of higher global energy prices, and it also said Middle East developments were adding a high level of uncertainty to the economic outlook. That is not hype. That is the central bank basically admitting the policy road is getting narrower. Now add debt. This is the part nobody likes talking about because it sounds abstract, but it is not abstract anymore. When interest rates stay high, the government's own borrowing cost becomes a bigger and bigger issue. Recent budget tracking shows interest payments on the national debt are still running extremely high compared with just a few years ago, and the pressure is not going away quickly. So the Fed has a problem. Cut too soon and inflation can come back. Stay tight too long, and debt stress and economic pressure build. Try to do both, and the market starts questioning whether anyone is really in control. That is the environment where gold and silver can attract serious attention. Not because they are magic. They are not. But because they sit outside the promise-based part of the system. They do not need a government to say they exist. They do not need a central bank to defend them. They do not pay interest, which can be a weakness in normal times, but in a confidence problem, that same simplicity becomes part of the appeal. Now, where could silver go? The exciting answer is that if the breakout holds, the market can start looking toward the upper 80s, and then that big psychological area around $100. But I want to be very careful here. A target is not a guarantee. A chart level is not destiny. Silver has a long history of making people feel brilliant right before it teaches them risk management. So instead of asking, how high can it go? Ask, what would prove the move is healthy? For me, a healthy move would mean silver does not just spike and fade. It would mean pullbacks find buyers. It would mean gold eventually confirms. It would mean industrial demand stays firm. It would mean energy and inflation risks keep hard assets in the conversation. And it would mean retail excitement does not become so extreme that premiums detach from common sense. That last part is important. Do not overpay. Physical silver is great, but premiums matter. A beautiful coin can be a terrible deal if you pay too much above the metal value. A plain bar can be smarter if the premium is fair. The goal is not to look fancy. The goal is to preserve purchasing power and stay flexible. And that brings us to the practical side. If you are building a silver position, think like a calm person, not a panicked person. Keep some cash. Keep some liquidity. Do not put every dollar into metal and then pretend that life cannot surprise you. Because life always surprises people. If your car breaks down, if your rent changes, if your business slows, if your family needs help, you do not want to be forced to sell silver into a bad spread just because you forgot that emergencies exist. So yes, stack if it fits your plan, but stack with discipline. A little at a time, fair premiums, clear storage, no emotional chasing, no pretending one asset solves every problem. If you are successful, share your success story in the comments so others can stay motivated. Now let's bring this back to the bigger point. Silver is not moving in a vacuum. It is moving in a world where energy disruptions are feeding commodity worries, where food and fertilizer pressure are back in the conversation, where the Fed is boxed in, where debt is expensive, and where investors are slowly remembering that hard assets matter. The latest commodity outlook also warned that energy and fertilizer pressures could lift broad commodity prices this year, which supports the idea that this is not only a metals story. It is a real economy story. That is why this setup has power. But the danger is emotional certainty. The people screaming that silver must explode immediately may end up being right on direction and wrong on timing. And in markets, being right too early with too much leverage can still destroy you. So watch the move. Respect the move, but do not worship the move. If silver holds these higher zones, the next leg can become very serious. If it fails, that does not kill the thesis. It just means the market needs more time to build strength. Either way, the investor who stays calm has a better chance than the investor who keeps reacting to every candle. So, is silver about to explode? Maybe. But the better way to say it is this. Silver has the ingredients for a much bigger move, and those ingredients are becoming harder to ignore. Energy risk, inflation risk, debt risk, supply tightness, industrial demand, monetary uncertainty. They are all sitting on the table now. The match is there. The fuel is there. The question is whether the market lights it now or makes everyone wait just long enough to doubt it again. Subscribe if you want more breakdowns like this and comment below. Do you think silver is beginning a real breakout, or is this still a dangerous bounce before the bigger move? And remember, this is for education and market discussion only. I am not telling you what to buy, sell, or hold. Use this as a framework. Do your own research, understand your own risk, and make decisions that fit your real life, not somebody else's excitement.